Hi folks, it's Björn here, and one of the challenges faced by traders and investors is to know when to sell a stock. And it is more easy to sell when the prices go down, but when to sell if the asset is actually making you money is a whole different story. As some who are new to the market may feel bad over selling their stocks before their peak, missing out on major gains, others hold on them too long in the hopes that the failing stock will rise again. This begs the question, how can you best decide when to sell? For those just starting out in the market, or even for veterans, you may be pleased to know there are many clues if a stock should be sold or not. So let's get started. As we know, for several years now, the stock exchanges have only known the upward direction. Although it is certain that we will eventually get in a correction phase, it is by no means foreseeable whether this will be the case this year, 5 years from now on, or even later. However, from an emotional point of view, it is understandable that investors are becoming more nervous, even if the emotional urge is great to liquidate all or a part of a portfolio as the stock market cycle supposedly matures. It is advisable, however, to focus on the actual purpose of the investment. Right, to make a tons of money. So, the goal of the value-oriented investment is to invest in very good companies and benefit from their potential in the long term, as very good companies remain very good companies, even in a correction phase. And the long-term investment approach not only increases your chance of exploiting the full development potential of a company, but above all, solves the problem of estimating the time of entry and an exit point. All in all, a long-term investment in a quality company is the key to success. And last but not least, this is one of the core philosophies of the star investor Warren Buffett. I quote, "Our favorite holding period is infinite." So, if you don't feel comfortable holding a stock for 10 years, then you shouldn't own it for 10 minutes. So, if you feel uneasy or have an emotional urge to sell your stocks, then you should investigate first the following list for the hard facts that speaking for selling. Or you may find that you have just surrendered to an effective impulse. So, let's start first with the 4 reasons why you shouldn't sell a stock. First, the most say, sell the shares when the prices rises dramatically, which is correct if we take, for example, AMC or GameStop. So look out for media hyped stocks, but for normal stocks, like for example Microsoft, where the share price has multiplied since purchase over years or decades even, it is not the case, as the historical price development cannot be an indicator of the future development of a share price. Rather, it depends on the development of sales and earnings. Only our emotions lead us to believe that the increased course carries the risk of correction, but the stock doesn't care what the price did in time. However, an increased price can also have increased valuation of the stock, and that would be a reason to sell a stock. And I will explain later on why. The second point why I would not sell a share. If the share price has risen significantly in the past few weeks, people value short-term gains and often neglect long-term opportunities. For example, many would prefer $1,000 today to $1,500 in a year, right? A short-term price increase is, as in point 1, no indicator of how a company is valued, and is certainly not of what movement the share price will experience in the future. That you have to understand. The third point, I believe the share price will fall and climb again with bigger gains. The principle of hope is not a good investor on the stock market, and experience shows very clearly that attempts to anticipate the market are based on pure luck and not on a permanently functioning process. Trying to trade such fluctuations will be put into a perspective because you will likely not be able to hit the entry and the exit points perfectly, right? In addition, you will experience higher taxes, transaction fees, and a certain amount of stress and on your nerves. And sometimes easy ways are way better. Fourth, I want to secure profits before the price fall. Here too, the emotionally plays a trick on us. You don't know today whether you're getting out too early or too late, because you don't know what the exchanges will do in the future. It would not make sense to secure profits if the price continues to rise in a row, right? You'd also get annoyed if you were heavily invested in a good company that is set to do well in the years to come. The professional point of view: if the price should actually fall, the market gives you the gift of being able to buy shares in a good company at a lower price, right? It's exactly like I did with BYD, for example. But even if you strive for a long-term investment situation, naturally rise in which original made decisions is reconsidered and should be corrected. These cases are covered by the next 4 points. So when we have a reason to sell. First one, the reason why you bought the stock turned out to be wrong. Even if it is of course the aim not to make mistakes in the stock selection, there will always be cases in which one has made selective mistakes, me included. Investing in stocks involves making decisions based on incomplete information, and new information can always emerge that was not previously known. It is all the more important to always be up to date with the equity investments, not regarding the share price, but regarding the company. So if new information appears that contradicts the previous reasons, a sale should be considered, right? Second, the fundamentals of a company have changed. There are a lot of cases when companies do not perform as expected. Such effects can exert an influence that changes the fundamental situation of a company. If the original goals are then no longer achievable, or the risk situation shifts to your disadvantage, a sale should also be made here. And that is as well what Warren Buffett was doing when he was selling his shares from the airlines, right? As we all know, with Corona, the whole industry suffers. Third, sell your stock for valuation. So, what it means, is the stock overvalued? The only thing that you should really drive you into selling a good company is overvaluing it. That means the best company is of no use to you if you pay too high a price for it. The background is that sooner or later prices will normalize. That is, share prices will fall. When the time comes, high valuations are a risk as they will fall back to normal levels. Equities are the same as any other asset. The health of a company that issues the stock can be measured through what is called a fundamental analysis. So, savvy traders, brokers, and those who know the market well often use financial ratios to gain insights and even predict how well a company will do in a given time frame. So, most companies keep a close guard on their financial details, and so the figures used to compose the ratios can be hard to come by unless you are on the list to receive updates from the stock issuers, right? But Be mindful when using ratios to compare stocks. The way ratios are calculated can differ. So when you're looking at 2 or more stocks, and that is important, make sure they are in the same industry and use the same internal accounting procedures, as you can't compare, for example, the PE ratio from Tesla with Microsoft. It's like you compare apples with potatoes, right? So there are many figures you can look to for a greater sense of a stock value, such as dividend yield, price to earnings, earnings per share, and dividend payout ratios. Other key ratios that can be used to deepen your knowledge of a company are their debt to equity, the quick ratio, the current ratio, or other liquidity. Basically, how fast they can turn assets into cash, and solvency, how fast they can pay off debts, right? And the fourth one, and probably the easiest way, is actually that you set yourself a price target, because many traders set a limit on a stock's price. So if it falls below a certain level, they sell to maintain a profit, right? You can also set an upper limit that triggers your sell. Your logic here might be that you fear the stock will have a hard time supporting a market price above a certain level, and that a hint of bad news might send the price into a nosedive, right? So setting limits on when to sell and when to buy ahead of times make tough choices almost an autopilot, and can help temper your fears. And some traders simply say, I want to make X amount of return. When I hit that, I'm going to sell and move on to another stock. This mindset can allow you to keep feelings out of your trades, so that you act with prudence. Over the time, this type of trading may reward you with higher profits, since you won't sell too soon or engage in panic selling, if you are the type for it, right? For me, it wouldn't be, because I'm not really nervous if a stock goes down, okay? But that is totally up to you what you choose here. Good news! If you watched the video so far, I'm really proud of you. And no worries, we are missing out only on the conclusion, and after that you are smarter than 90% of all other retail investors. So let's start with the conclusions. And basically what I want to say, there are things that we can control and things that we are not in control of. Stock market prices do not belong in our control area, which is why there is little point in trying to forecast them. We have to accept fluctuations in exchange rates for granted, right? But we can influence, however, what kind of companies we hold in our portfolio, and we can influence the probability with which we hold companies in the portfolio that have a bright future ahead of them. We can also influence the valuation risk. We can calculate how highly a stock is valued and make the decision whether or not to be invested. That is what we should focus on. On the other hand, we should try to control the emotional influence of our brain as much as possible, since this does not necessarily result in the best long-term decisions. So, to sum this up for you guys, check financial ratios. Set the price target if needed for you. Check if a company is cutting back on dividends. Look out for media hype. Deal with stocks if growth is stagnating. Don't sell all of your holdings, and be mindful of trading too often. While the goal is always to make the most gains on your investment, don't forget to keep an eye on your back-end costs that come with each sale, right? Brokers make money by charging a % of each sale. And if you sell too often, you eat into your profits by running up a large broker's bill. A few smart traders will beat a dozen second-rate trades any day. And last but not least, a little tip from my side. If you want to work with a stop loss, set it to 15%. Means if you bought the share for $100, set the stop loss to $85. If you can't handle that prices can go down by a lot. If you are interested on how to analyze stocks, however, I made a video to it and link it up here. But before watching it, let me know in the comments what is your selling or exit strategy, right? That's it for today. Thanks for watching, and as always, stay focused and don't get greedy. See you all next time.